Hello everyone. This is our discussion of the things we need to know about earnings per share. Way back in our week 3, when we reviewed the income statement, we made the point that earnings per share was a required disclosure, meaning it needs to be shown on the face of the income statement, and that it was net income minus preferred dividends divided by weighted average shares outstanding. We did not get into detail about the difference between basic and fully diluted. We did not get into the detail about how to calculate that weighted average shares outstanding. It was just given to us and we just divided back when we learned about it in chapter 3. We also learned that, as we'll review, that it needs to be there could be more than one calculation for earnings per share in terms of if there are special items such as discontinued operations. So here we're going to go into the basic and fully diluted concept with regard to earnings per share. So jumping right in to our discussion, companies either have a simple or a complex capital structure. If they have a simple capital structure, they have what we refer to as dilutive securities. When we use the term dilution or dilutive or dilute in an accounting sense, if you're cooking or you're doing something with water, if something is too strong, you put more water in it, it dilutes it. It has a similar connotation in accounting. If there are more shares, it dilutes the earnings, meaning you have to share them with more people, with more shareholders. So if you have no securities that would be likely to be converted into common stock, then you have a simple capital structure. So dilutive securities are securities that right now are not necessarily common stock, but could become at any point, usually at the option of the person who owns those securities. Then if they can turn them into stock at any time, then what we're looking for is the idea that could dilute the existing shareholders' earnings, because they would have to share with those new shareholders. So if you have a complex capital structure, it means you have at least one dilutive security and maybe even more. The dilutive securities that are most common are convertible preferred stock. So this is preferred stock that can be converted into common stock at the option of the preferred stockholder. So at any time they could show up and say, I want my preferred stock to change into common stock. And there will be an exchange rate, if you will. Usually a lot more common stock than preferred, like 5-to-1 or 6-to-1 or 10-to-1. There is convertible debt, where you have borrowed money from investors, and instead of paying them in cash, you could actually pay them in common stock. And they get to choose. It's convertible at their request. So they get to choose. Do they want cash or stock at the end, okay, or even sometimes before the end. So that could become stock at any time when that individual investor decides to do that, if they decide to choose stock. And then last is options or warrants or even restricted stock units. What we'll do with options or warrants, they're really the same idea. The idea is you can buy stock at a set price, no matter what the market price is, at your option. So you have like a piece of paper that tells you that you can buy stock at a set price. Restricted stock works very much the same way, except they actually give you kind of pretend stock that at some point you can convert into the real deal. All right. It's a one-to-one type of thing, so it's not like the preferred stock conversion idea. So when we're calculating weighted average or the earnings per share, we always start with basic. We always use our initial net income from continuing operations, or net income, just at the last number on the income statement, minus the preferred dividends, and divide by weighted average shares outstanding. We include preferred dividends paid and even those that are declared but not paid. So even if they haven't been paid, the preferred dividends, as long as they've been declared, are subtracted out of that. So how do we get this weighted average? We take the shares outstanding times the portion of the year outstanding. In real life, this is done on a daily basis. Literally every day we calculate the number of shares outstanding because they could be changing fairly often. All right, and multiply by the part of the year that they're outstanding. We will use monthly because we'll make all of our situations happen at the beginning or end of the month, so we don't have to get into that kind of level of detail. But the principle is the same. So if you convert securities, that we always have to, that changes from being pretend shares to real shares on the day of conversion. We always treat stock splits and stock dividends as if they happen on the very first day of the time period we're dealing with, usually the year. All right, and we include restricted stock that is vested. So restricted stock, just so you know, is that shares that are given to employees but have restrictions on their being able to sell it until they become vested, and that when it's vested, it is included in our number of shares. If we have a loss, we will only do basic. We will stop after basic. If there's a loss, instead of net income, it's a net loss, or a net loss from continuing operations, then we only use basic. So what about complex? What if you have a complex capital structure? That means you have dilutions, you have something that is going to cause dilution. So the first one, you always start with stock options. So if you have more than one dilutive security, always start with the options. So it is dilutive and is included if the exercise price is below the average market price. So we'll get to the end of the year, we look at the exercise price. That's part of the contract. That's part of the original option situation. And the same thing with warrants, same thing with restricted stock. If that price is below the average market price, then it's dilutive. That means that they're likely to use it. You're not going to use an option where the exercise price is above the regular price. You would not go into the store with a coupon to buy something for $30, all right, and if it was on the shelf for $25, insist on paying $30 because you have a coupon. That wouldn't make sense. You wouldn't use that coupon or that option, if you will. Okay? So if we have those that are dilutive, we use the treasury stock method. So we figure out how many new shares are going to be issued because of all of them. We're looking at the worst case scenario for dilution. We're looking at all of the options being exercised that are dilutive at least. And then we subtract the shares that are soon to be repurchased. So how do we know what shares should be repurchased? It's always whatever you got. When people exercise their options, they give us cash for shares, right? That the option is a coupon to buy the stock at a set price. They're going to give us cash. So we're going to assume that they did that and they gave us cash. And we're going to use that cash to turn around and buy shares in the market at the average market price. Okay? Same thing with the restricted stock. Okay? We're going to include that with the market price and then multiply by the number of shares as the proceeds. Okay? So you're going to still utilize that value to buy back, pretend to buy back shares. Here's the example actually used in the codification from the FASB. We have 10,000 shares outstanding, exercisable $54. Average price of the common stock during the period is 60. So this is diluted, right? Because the price per share that exercise is below the average market price. So we exercise the warrants or the options and issue 10,000 shares. That's assumed. It hasn't actually happened. We're just going to make that assumption. That would result in us receiving $540,000 in cash. Then we would turn around and use that $54,000 to buy shares at the average price of 60. That would buy back 9,000 shares. So the incremental shares, the actual amount of increase in the shares would be 1,000. All right, and that's what would be used in calculating our diluted earnings per share. All right. So next thing we would look at is if we have convertible bonds or convertible preferred stock. Always start with basic regardless, okay? So it doesn't matter. If you had stock options, you've already done that part of it. Now you move to considering convertible bonds, convertible preferred. We're going to pretend that they are converted. All of them are converted. So we increase the numerator, okay, the lower top. So remember the formula was net income minus preferred dividends. If you're doing preferred stock and it's convertible preferred stock, then you would not, you just add back in the dividends that you just subtracted. If it is interest, if it is convertible bonds, then you're going to save interest, because if they converted it to common stock, you wouldn't have to pay interest. So you're saving the interest that would be added to net income. But you need to consider taxes only on the interest, not on the dividends, not on preferred dividends, because they don't count for tax purposes. But for interest is tax deductible, so we need to adjust for the income taxes. So if the income tax rate is 30%, you're only going to add back 70% of the interest that you saved. You increase the denominator, the number of shares outstanding, by the shares to be issued with the conversion. So you need to know what the conversion rate is per bond or per preferred stock. You start this on the date, as far as considering what dates to use when it is issued. So if you issue convertible bonds during the year, then you don't consider the first part of the year. You'd only consider the interest in the shares for the second part of the year after you issued it. And it ends when it's converted, because once those bonds or preferred stock are converted, then you would actually converted for real. You would not consider them as part of your shares as your extra pretend shares anymore. So, example. Basic formula we start with: net income minus preferred dividends, 300,000, and divide by the 1.3 million weighted average shares outstanding. That would be from our earlier calculations involving just the basic, or just the basic plus the stock options. Okay? The preferred stock at $100 par is all convertible common shares at a rate of 10 common shares per preferred share. Outstanding for the whole year, so no need to adjust for the time period. Preferred stock converted for the whole year, then preferred dividends would be 0, and the numerator would be 2 million, because you would no longer subtract out preferred dividends. So now you're at 2 million divided by whatever our weighted average shares outstanding. But if they converted for the whole year, they would have converted it into 300,000 additional common shares. All right? So that's because there's $3 million worth of preferred stock at $100 par. That you divide the $3 million by 100 to get 30,000 preferred stock shares, and each of those is convertible into 10, so you have 300,000. So your new formula, your diluted formula, is 2 million divided by the 1.3 plus the 300,000, or 1.6. So remember, in real life, EPS gets calculated every quarter. It's one of the numbers that, even if you publicly traded companies have to report their financial statements every quarter, and they calculate earnings per share every quarter. All right, basic and diluted are computed for continuing operations and discontinued operations. Back in chapter 3, week 3, we learned about separating out discontinued operations. If that exists, we have to calculate earnings per share separately, both basic and fully diluted, for the continuing operations and discontinued operations. If there's no discontinued operations, then you just have basic and fully diluted. You don't have the extra. And that is the only special item that requires separate earnings per share calculation under the current U.S. GAAP.